Jason, I know I promised you I would do the intro today, but I'm too goddamn triggered by this topic to do an intro. I shit you not. I tweet out that we're doing an episode on risk parity, and the first response is it's just levered bonds. Twitter is no longer a safe space for me. It's not a safe space.
I don't think you've seen some of the latest ones in the last few minutes. Even like Jeff Malik trying to troll you, like just showing, hey, look, it's in Wikipedia right here. It's just levered up bonds and stocks.
I'm not going to get through this episode. Look, welcome everyone. Thank you for joining us, whether you're live, listening to us in the future, whether it's the podcast or YouTube. We appreciate you taking the time out of your day to spend it with us. My name's Corey Hoffstein. That man there, man, I got to remember when I point, for those of you listening, I'm trying to point on the screen. When I point, it's backwards, which you'd think I'd understand. That man right there is Jason Buck. The man behind the scenes, orchestrating this like the puppet master, is Jack Farley. Jack, thanks for doing what you do. This is Pirates of Finance on Blockworks. Jason, today we're talking about risk parity and why everyone seems to get this wrong. So let me start with a question for you. What do you think risk parity is?
Well, one in my head, all I ever think is Risk Party that Meb came up with. I think Meb has that ticker reserved as Meb has every ticker.
I think he has that URL reserved.
Or that's what it is, the URL. He was trying to sell it to the Resolve guys. I think.
Meb Faber from Cambria Funds, prior to his ETF days, my understanding is he used to buy a lot of domains. That was his thing. So I think he's just got this history of buying domains, and now he does a really good job of reserving great ETF tickers. Neither here nor there. Quit dodging the question, man.
So from my understanding, at least the way I've always thought of it, is risk parity includes basically all asset classes, stocks, bonds, commodities, real estate. But the entire point is that you're attenuating the portfolio to the risk premium from each asset. So you're looking at the historic volatility of each asset class, and then you're either levering up or delevering that asset class to make sure it's even across the board to your different sleeves or buckets that you're allocating to. But I never thought of it as stock bonds. And I'm not just saying that because I don't want to trigger you, but that was the way I always understood it. That was just part of the portfolio, and you're trying to get more income streams. And I think historically, a lot of people think about it as coming from Bridgewater with their all-weather portfolio, but I think it was Panagora that actually defined the term. But for me, even with risk parity, when I always thought about it, was the idea with Ray Dalio is always talking you need 16 uncorrelated return streams. So I don't know how you count 16, but it's not just stocks and bonds to me.
I mean, look, somewhere along the way, people got confused. People started to think that risk parity just meant levered stocks and bonds and more levered bonds than stocks, right? The whole idea, if you just sort of use the two words, is you're creating a portfolio where the contribution of risk is equal in what you're allocating to. And so a lot of people this year are slamming the table saying risk parity's getting crushed. Stocks are down, bonds are down, risk parity's really not doing well. Except if you go look at risk parity funds, they're doing quite well, because no one in the world has ever run a risk parity fund that is levered stocks and bonds. I honestly have no idea where this concept came from. Macro people seem to think it's true. No professional investor in the world runs a risk parity fund like that I'm aware of. I think you're right in terms of history that the original risk parity fund was Ray Dalio's Bridgewater's all-weather strategy. And the core concept there was we're going to break sort of the world down into a grid. And we're going to have inflation and deflation, economic growth, economic contraction. We're going to sort all these different global asset classes into the quadrants. And we want to allocate equally across those different quadrants in a way that all the underlying assets are contributing an equal amount of risk, right? Because if I buy equities for economic growth and 2-year treasuries for, I don't know, economic contraction in a deflationary environment, well, they have very different volatility profiles. So I need to normalize using leverage how much exposure I have to each so that I'm getting the same amount of sort of dollar risk from both. So that was like the original.
You just triggered me, though, because you said Ray Dalio and the 4-quadrant model, which drives me nuts because it goes back to 1972 and Harry Brown. And Dalio copied that, but then never said anything about Harry Brown. So, and I'm sure we can go back all
Well,
the
the
way back to the
winners rewrite
Talmud.
history, right?
Yeah. I mean, we can go all the way back to the Talmud if we start talking about proper portfolio diversification. So who knows who started? Maybe it started before that.
So in this original model, there was some idea of volatility, but it was like long-term volatility, not this, oh, they're immediately, changing position sizes. And correlation matters, but it was much more around economic intuition. Somewhere in the early 2000s, I think it was Panagora that started a quantitative risk parity fund that said, we can take this concept and do it mathematically. If you give us a covariance matrix, which tells us about the volatilities and the correlation between asset classes, we can solve an optimization such that every single asset we allocate to contributes an equal amount of risk. And as the market changes, we can change those allocations. Same idea. Both of them sort of get called risk parity. But again, it was never just stocks and bonds. And I have a theory as to where this stocks and bonds thing came from, but it's just a theory. Just a theory. So when risk parity started getting more popular in the narrative, what you saw was people explained risk parity through the lens of a 60-40. They said, look, if you take a 60-40 portfolio and decompose where most of the variance in your returns is coming from, it may be a 60-40 allocation of your capital, but 90% plus of your risk is coming from the stocks. That's not risk parity. That's massively overwhelmed equity. What you really need to do is increase your allocation to bonds. So it'd be like 80% bonds, 20% stocks, and that would get you to much closer to an equal risk contribution. And then you'd need to lever that portfolio up to get back to the same risk profile. So I think that explanation was used. And then the next step was to say, but of course you don't just want to do it with stocks and bonds because you're massively sensitive to inflation risk or inflation volatility. Let's include commodities and potentially currencies. And you even see people include some hedge fund betas from time to time when you get into some of the weirder ones. But it's a global multi-asset portfolio. And I feel like people heard the first part and just never learned the second part.
Why do you think? Do you think it's because everybody likes a boogeyman or something to make fun of? Like, and this is what's driving you nuts is like everybody they just quote risk parity and they're gonna get their face ripped off in this environment. And then because they're just talking about the stocks and bonds, and they assume that people just run this levered bond position, indefinitely, no matter if bonds are losing money or not, that they're just gonna take it to the face on bonds. Or
I have no idea how this propagated, and it has, right? If you go to Bloomberg and you type in for the Bloomberg Risk Parity Index, it is a stock bond index, which blows me away that Bloomberg would do that. So maybe at this point, I just need to accept that risk parity means this stock bond thing. Like it's sort of like when people use a word incorrectly enough, it redefines the word. Maybe we're just past the point. I can't say this. We've changed the definition and I'm wrong.
So
but I don't think I am.
So 60-40 literally means stocks bonds. I just because you see what I did there with your changing of the words.
Yes, 60-40 literally means stocks bonds, but people are still wrong about this. Even if it is just stocks and bonds, and you lever up the bonds, they're missing the other point, which is there's a target volatility aspect to it. Right? You don't just lever it up to some constant volatility level. Risk parity then says, okay, what target risk profile do we want? If you have a 60-40 portfolio, you are choosing a static allocation with a varying risk profile over time. In 2008, that portfolio was far more volatile than it was in, say, 2017, which was a very calm, strong bull market. So static allocation with a variable risk profile. The risk parity concept flips that and says we're going to have a dynamic allocation to try to hit a constant risk profile. So when you get into a market environment like this, where a 60-40 starts being more volatile, what you can find is a risk parity portfolio, let's say targeting 10% vol, would just start adding cash to keep volatility low. And even though it's quote unquote levered stocks and bonds, can end up being less risky than your static 60-40, which in theory has less bond exposure.
Well, let's talk about a few things you said there. Let's start with the idea of risk parity, because we've been dancing around it, but just to clarify, is measuring the portfolio on volatility of the asset class, and volatility being variance. But once again, if you're using you're using a look back to figure out what the volatility of that asset is. So it depends on what length and term of the look back you're using. So like you were referencing is, let's just say for using the shitty version of stocks and bonds, right? You're looking at your stock volatility over a past look back period, and you're looking at your bond volatility over the past look back period. But then you said then you want to combine those and look at your target volatility at the portfolio level. So so if we're going to be we got to be both positive and negative for some of the things that go on with risk parity. And one of them is that target vol at the portfolio level that then goes down through the individual asset class is really depending on which look back period you use.
Yep.
And therefore is dependent on past volatility. So like you're saying, if you're in a quiet period, you may be levering up. And then if something dramatic happens, like we call a VAR shock or a liquidity cascade in March of 2020, you could have been leveraging up in a quiet environment, almost in a Minsky-like sense. Stability breeds instability. And you had that target vol, had you levering up those individual assets, and you can get kind of your face ripped off a little bit, in a sharp down move. Is that fair, or did you have contention with that?
It is very dependent upon the model. What you find is some risk parity models use very long-term volatility profiles and very long-term correlation profiles. Some forego correlations or try to normalize correlations to sort of a economic regime-based approach where there's like a model that they build that they say this is our assumption and we're going to sort of anchor to that assumption. You see others that are much faster, and some that might use long-term correlations and short-term volatility input to build a covariance matrix to be more reactive to the volatility, but less reactive to changing correlation profiles in the short term. So it is very dependent, and it is one of the big model risks for sure of a risk parity approach, is that we're assuming we know ex ante what the risk of these assets is going to be and what their risk relative to each other is going to be. And we don't know that. We can try to model it and we can try to guess it, and maybe we can get close, but we're certainly going to be wrong.
Yeah. And so I want to build up these layers. So like we were just talking about the idea of volatility, then you've been hinting at correlation too. So one thing is the individual asset class volatility. And then when you're building a covariance matrix, like you're saying, is you're taking, multiple asset classes and looking them across the matrices. And part of that is you're looking at the correlation between those two assets. But once again, most people are using a simplified Pearson correlation, which is once again based on look back. So if you look back and stocks and bonds have been uncorrelated or negatively correlated, that might affect your target volatility at the portfolio level. And so if you're in a scenario, and I think this is really what people are hinting at on Twitter that's driving you nuts, is the idea that correlations are shifting. And, if we look at over 100-year period, 150-year period of stock bond correlations, most of the time, actually, stocks and bonds are correlated. In the last 20 to 40 years, we've seen this negative correlation between stocks and bonds, which has obviously done incredibly well for a 60-40 portfolio. But the question now is in an inflationary environment or a rising rate environment or a rate of change in rising interest rate environment, do we see stocks and bonds become correlated again? And that's where people are really trying to bash risk parity, is because if it is just stocks and bonds and they're saying that correlation has changed, then your leverage and your volatility should change as well, correct?
And that's exactly what happens.
Yeah.
That's the part I don't get, is people go, oh, a levered, even if it, again,
yeah,
I fundamentally disagree that levered stock bonds is risk parity. Fundamentally, no institution in the world runs that as a risk parity strategy. That said, by the way, what I think is funny, another potential source of where this came from is Cliff Asness at AQR wrote a paper back in like 2013 about risk parity. And the whole first part of the paper is, let's show levered stock bonds portfolios around the world compared to static allocations. And then he includes commodities later. So again, maybe there's some of that. But to your point, yes. So everyone's acknowledging stocks and bonds are both potentially sensitive to inflation risk. That's when you tend to see them both go down at the same time. When the market stops caring about economic risk and starts caring about inflation risk, we have this huge inflation risk hole in a stock bond portfolio. And so what you would expect is the correlations go up, and therefore portfolio volatility goes up. But to the point I made before, risk parity portfolios target a volatility level. So your static 60-40 is now becoming more volatile, and your levered stock bonds, guess what it's going to do? It's going to de-lever. It's going to change its leverage.
But how do you think they think of, like you were saying, it could be longer term look backs or shorter term look backs, and that's going to be the secret sauce of the people implementing this, is like how quickly they respond to correlations.
But again, no one's doing this. Like I get what you're saying. You're saying
no. We'll get to the other asset classes later.
In the hypothetical case that someone decides they're going to use a 20-year look back of stock bond correlations to run a levered stock bond portfolio, yeah, they're fucked.
Yeah.
I don't know if I can say that.
Yeah, of course.
Jack,
of course.
Rewind time and beat me out.
No, of course you could say that. What are you talking about? And so, but that's what I'm saying. The ability to shift those allocations is really going to depend on how quickly or what their time frame is for their look backs and how quickly they adjust their portfolios. But that has both pros and cons that hopefully we'll get to later, as far as like if you're going to get whipsawed or you should ride those trends, etc. But I'm trying to build out that matrices because it's really difficult if we're essentially looking through the rearview mirror to predict the future. And if we're using previous volatility and previous correlations, there's times when volatility and correlations can change on us pretty dramatically. And so every trading strategy has pros and cons. So I'm just trying to highlight both the pros and cons in this theoretical portfolio.
With any portfolio that dynamically changes its exposure based on portfolio leverage. So this is risk parity strategies. This is CTAs do this somewhat. Any target volatility strategy actually is introducing a covariance term into its return stream that's based upon prior measure of vol versus future returns. You are changing your leverage up and down. And so if you find that actually, let's say, returns and volatility end up being mean reverting, that the market sells off and vol goes up, and then what happens is if prior vol goes up, actually future returns are good. Well, what's going to happen is every time vol goes up, your portfolio is going to delever. You're going to introduce cash, and then future returns go positive. And so you actually end up getting whipsawed, right? So that covariance term is negative, and it's actually a drag on your returns. What you find in different asset classes is that relationship between prior volatility and future returns really varies. In equities, it actually seems to be, I got to think of the way the sign works here. When you have higher vol, you tend to have negative returns. And so what that means is that doing a target volatility on equity specifically is sort of a little bit like trend following. You tend to de-risk and future returns tend to be worse, and so it ends up being beneficial. The same is not true in something like bonds, where there seems to be no relationship and therefore no benefit to doing any target volatility. But from a portfolio composition level, it's non-obvious necessarily whether it's additive or subtractive. But to your point, it can create this whipsaw that volatility picks up. You start adding cash into your portfolio to keep the leverage constant, to sort of say, hey, markets are getting a little crazy. I need to add a buoy in here. And then markets rebound and you miss all the upside.
Yeah, so I want to pull a few things out of there. One, you said CTAs again, which we've talked about in the past, which is commodity trading advisors. But in this case, you're referencing trend following, which is over 90% of CTAs are trend followers, which they can go long and short the commodity futures markets around the world, and they're typically just trying to ride that trend in either direction. And a lot of them will also have a target volatility that they're trying to be within a band of, like if a 10 or 15% target volatility at the portfolio level. And that's what a lot of them have gone to over the last, decade plus. And so what the idea is, like you're saying, is I want to give a very specific example. If we're going into March of 2020 and people are running fairly levered because volatility in the markets have been low. And all of a sudden, March of 2020, a liquidity cascade happens. Like you said, they're going to rush to cash, but also you're rushing to cash and you're trying to get out of the fire exit in the theater before all the other target volatility funds, which is always kind of funny to me, is like they're trying to rush out. So then you're going to cash because you don't want to take the large hit. But then because you went to cash and you lowered that volatility, if you then have a V-shaped recovery like April of 2020, you're going to get smoked on the other end because you're going to be underexposed because you adjusted your portfolio based on volatility. And there's nothing necessarily wrong with that. I'm just saying that is the con to having a target volatility level at the portfolio level, is like you can get whipsawed pretty badly. And I just want to make an example of what that whipsaw would look like in real life, giving March of 2020 as an example.
And that is something we certainly see. There are firms that will try to forecast volatility. So when vol is very low, for example, they may not lever up as much as maybe the numbers say they should, because they say there's actually this latent risk out there, or they may lever up and buy some form of protection if they can. But every mandate's a little different as to how they handle this. But again, in practice, those target volatility strategies, of which risk parity traditionally falls under, as markets get more chaotic, as we start to see bonds be more volatile, commodities be more volatile, equity markets be more volatile, they typically reduce their exposure. And so coming into this year, if you actually look at how risk parity strategies were allocated, their gross leverage, the total amount of exposure they had to stocks, bonds, commodities, across the board, was declining and much lower than it was in, say, January 2020, because you had in November a lot of volatility in commodities. You had in Q3 and Q4 last year increasing volatility in rates. And then right into you also had some volatility in equities, last November or September? Can't remember which. So you had this volatile Q4 in all the asset classes, plus increasing correlations with stocks and bonds. That just led to risk parity strategy saying, we need to hold more cash. And so as the market has sold off this year, they just haven't had as much exposure. Plus, they've been decreasing their exposure to equities and bonds and increasing their exposure to commodities as a ballast.
Yeah. Before we get to the commodity side, I want to talk about the stuff you brought up with bonds too. Is like, why do you think that as vol increases, you don't necessarily decrease or increase your returns on the bond side? Do you think it's just because you have the deterministic cash flows, and that's what makes it so different from equities, which are more like a forward projection?
I just want to say, by the way, I'm not sure I can be this angry for a full hour.
No,
I might have to take a break and walk around.
I'm going to just keep fanning the flames as much as I can.
Triggered Corey is the best Corey. Not the best for my heart. Okay. Why not bonds? I think there's probably part of the cash flow aspect there. I also suspect that they tend to be a flight to safety asset, right? So as markets get more chaotic, you tend to see people being forced to buy treasuries, posting it as collateral potentially. Right. Versus in the equity market, as things get more chaotic, people are getting margin calls, which is creating sort of a self-fulfilling spiral. Although that's not to say we couldn't now be in a regime that you could see the same with bonds, right? It may be that it just over the last 20 or 30 years, when you look at these studies, target vol on bonds wasn't very successful. But if inflation remains the persistent top-level risk that markets care about for the next 20 years, then maybe you do see target vol is additive to bonds. It just historically hasn't been.
There was another question I had for you in bonds, and it completely blanks on my mind. So maybe I'll think of it. But when I ask you the next question, and maybe this is another reason why people like to shit on risk parity so much, is most of the time they're referencing an ETF that runs a risk parity model. So maybe you want to talk about maybe why that's difficult to actually run a full risk parity model within the ETF structure.
Well, yeah, I'm not sure it's any more difficult necessarily to run one in an ETF structure than a mutual fund structure.
Well, you can't put the commodities and everything like other
the commodities get hard. So the big difference with a mutual fund structure versus an ETF structure is how cash gets into the portfolio, right? In a mutual fund, when you manage a mutual fund, you wake up, someone's bought your fund, you get a cash report in the morning, and the cash is sitting in a bank balance sheet, and you decide what to do with it. When you run an ETF, you are typically getting what are called creates and redeems through a market maker who's saying, hey, I would like to buy some shares from you. and here's either cash or a basket of securities. And typically it's a basket of securities. And that's what enables ETFs to be so tax efficient, is you're trading securities back and forth with this other party. You can't do that with futures. And they figured it out with options now, I believe. But I don't think you can do it with futures. So so the futures process requires you doing a cash basket, and then you need to basically move the cash normally to a Cayman blocker.
That's the issue. Is it's, you can do options now. That's the new rules. And then, like you just referenced with futures, you have to put them through a Cayman blocker. It can't be more than 15% of your fund. It can't be levered.
There are funds,
but nobody's making a market in it though, too. So if you actually do it though, your spreads are going to be so wide because the APs don't know how to make a market in it. So like, you're damned if you do, damned if you don't, kind of thing. Because I remember. Go ahead, sorry.
I was going to say the Cayman blocker, if you do a look through and holding. So as an example, DBMF, it's a managed futures ETF, does this. Their financials exposure, like equities and bonds futures, they hold in the ETF, and then the commodities they hold in the Cayman blocker. And if you look at the holdings of the ETF, you just see this 25% allocation to a Cayman corporation with no ability to see what's in there. So to your point, market makers, if they have zero insight as to what's in the ETF, it's hard for them to quote what the price of the ETF should be, other than the people who manage the ETF publishing intraday NAV.
Right. I remember the other thing about bonds, because I know this is usually one of the normal pushbacks you hear a lot. And just to keep fueling your anger, the idea that it's leveraged bonds is, what do you think? We brought up Minsky before, like stability breeds instability. Is if you're leveraging up bonds, you can have an extreme left tail in bonds, and having a leveraged version of a product that has, an amazing left skew to it, you can get really smoked if there is some sort of default event on the bond side.
So what's the question there?
Like, do you think that's the risk of ruin? Like, how do you think, like, if you're leveraging up bonds 3 to 4x and you have a left tail event that comes out of nowhere, that can...
Yeah, look, you lever up anything and you get a big left tail event, you're smoked, right? There's a knockout factor here, which is called a margin call. So yeah, you do need to be careful there and posting sufficient collateral. But the thing I would point out is levering up, say, 2-year US Treasury futures, levering up those 5 times is probably still less volatile than levering up equities, just holding them 1 times exposure, right? So leverage in and of itself doesn't really tell you the risk necessarily. You sort of need to look at your dollar risk and then make sure that you have sufficient collateral to meet any sort of margin call for the type of really bad sell-off you could see. And yeah, bonds can have really bad left tail events. I would hope we never see a US default of any kind, but you can certainly see very big one-day moves in US Treasuries, and therefore you need to have enough collateral. But for something like a risk parity portfolio, what's typically happening is all the cash is cross-collateralized for all these futures contracts. So yeah, maybe your bonds are getting smoked, but oil's having a really good day, and it doesn't really matter. All the cash is just sitting there.
Yeah, you just hinted at 2 other things, and that's one, to run a proper risk parity portfolio, you're probably going to be able to need to use managed futures and commodities. So you're going to need to, and you have implicit leverage there. And like you said, you can cross margin it, so it's very capital efficient or cash efficient. Because I believe it was Panagora that used to write about this all the time. Is one of the key tenets to their risk parity portfolio is you have plenty of cash to meet margin calls. So that's where you're prudent, is on the cash basis. And you were referencing that. But I just want to highlight that that's also part of it, is like imagining worst case scenarios and then double, tripling those, and make sure you have enough cash to meet the margin calls in those sorts of scenarios. So now moving on from, just stocks and levered bonds to why don't we see this in ETFs, is like, now you asked me at the start, what do you think the first addition is in risk parity stocks and bonds? Is it commodities?
I think traditionally that is the first addition.
And then is it buy and hold commodities, or are you trend following commodities?
I think that's a good question. I think it's buy and hold. I think sort of like, if you were to say build it up from an academic perspective, I think you look at someone like a Panagora from a quantitative, like who are building this out. You are adding buy and hold commodities, and that's sort of the third leg of the stool to manage inflation risk. And obviously commodities are such a broad exposure. I really hate just saying all commodities, but it is true. You'd add your softs and your precious metals and your ags, and you'd try to get as much exposure there because you're introducing a ton of different markets that had beneficial diversification to the portfolio.
I want to bring up because it just so happened that the mutual homie Med Faber had a tweet the other day, and he said you get to choose only one to add to a traditional 60-40 portfolio to increase risk-adjusted returns. What do you add? And the options were foreign stocks, buy and hold commodities or gold, manage futures trend, or real estate.
I was blown away by this poll.
It was equal across the board, right?
I don't understand how that's equal.
Right. And so I wanted to shout out Taylor Pearson and his Interesting Times newsletter, my partner Taylor. He used Meb's thing, and then he started writing about using historical data. The answer to this question is trend following by a pretty large margin. But why don't most investors use trend following in this case? He said this post, and I believe this post was by Pneumatic Samuel, so shout out to him, I think its best answer is trend following is complicated and kind of abstract. The last reason trend following isn't more popular as an investing strategy has to do with its complexity relative to stocks and bonds. What is a stock? A sliver of ownership in a company. And bonds, basically loans. Buy and hold them tight. Easy enough to understand, right? And how about trend following managed futures? An investment strategy that takes advantage of long, medium, or short-term moves in various markets utilizing various techniques, calculations, and timeframes while paying close attention to trade signals, current market price calculations, moving averages, and channel breakouts determine whether or not to go long or short. In my experiences, people have a legibility bias. They tend to like things that are simple and easy to understand. I think this is one of the reasons why so many retail investors get into real estate. A house or apartment building is easy to see, touch, and feel. It's legible in a way that a systematic trend following strategy is not. In my opinion, most investors would do themselves a great service by taking the time to better understand more illegible strategies like trend following.
Yeah, I think that's spot on.
Well,
I think that's spot on. Right? But let's add like commodities, which I think people sort of intuitively can grasp.
Yeah.
The problem, at least from my perspective as a financial professional, is I have no good reason why there would be a positive expected return to commodities. Right? There's arguments as to if you're buying commodity futures, there might be some sort of roll benefit. I don't know if I buy it. I don't know if I believe commodities should have a positive expected return. So you've got your financial stocks and bonds that I believe have a risk premium to them. Commodities, then any allocation you're taking away from stocks and bonds to add to commodities, you're lowering the expected return of your portfolio. And the only way to make it up is basically through diversification benefits. That you keep rebalancing when commodities are doing well and stocks and bonds are doing poorly, and you're buying them, stocks and bonds, when the expected risk premium is elevated. That's really the only way, to me, unless you believe that commodities have a positive expected return, that they're beneficial to a portfolio. Now, that said, it works in risk parity if you can use the leverage to maintain your exposure to stocks and bonds and then use commodities as a ballast for that inflation risk.
Yeah, the other thing I want to highlight about legibility too is like I always love playing this game too. Is like people do think they understand stocks and bonds, so I'm like pick their favorite stock, start asking them a lot of questions, and it turns out they don't understand their favorite stock. You get this a lot with like e-com guys. Are like, well, I only invest in Amazon because that's what I understand. It's like, well, now you're triple levered to Amazon, but also you start asking about AWS and all the other Amazon. And of course, they don't know what they're talking about. They think just because they have an e-com company on Amazon, they understand Amazon, and then I want to say it was Jason Zweig, but it might be somebody else. I'll just attribute it to him. But it was something great. Is like always just ask somebody who's the CFO,
right?
And they'll never. That's
Listen,
how well
as
they
a quant,
understand.
I don't even pretend to know the companies I invest in. So
right. But I think that's why Taylor Pearson has another great essay called Reality has a surprising amount of detail, and it starts with like draw me a can opener. Reality has a surprising much more detail than we realize, and so even though we think that stocks, bonds, and real estate are legible, as a former commercial real estate developer, I can tell you it's not as legible as you think it is.
Well, I agree. I think often those of us in the investing profession, believe that people understand this stuff way better than they do. I remember I was at dinner probably a decade ago in my earlier professional career with some friends out of college and some of their friends who were now doctors. and one of the doctors learned that I worked in investing and was saying, hey, I've got this 401k. They have these things called mutual funds in them. Is that a good investment? Like, as if a mutual fund was different than a stock and a bond. Like, just had no one had taught this person basic finance, right? So again, like, does the average person understand, not even like, what Amazon really is as a company? Do they even understand what a stock is? Like, people in finance probably get a good understanding of, like, okay, a stock is a share in a corporation, and you can sort of, that's tangible. Bond is debt, that's tangible. There should be cash flow there. The average person does not get that.
Right. Well,
I get that anyone listening to this podcast, by the way, at minute 36, I expect certainly does. Otherwise, this has been complete gibberish.
But in fairness to that, doctor, if you cut a body open, you and I have a rudimentary understanding of anatomy. That probably wouldn't be sufficient for that framework.
Rudimentary is overstating my understanding.
Exactly. The was the knee bone's connected to the leg bone. But then part of it. So if we're talking about adding commodity or commodity trend to a portfolio, as we've discussed many times before, is there's studies going back decades that if you're looking at an efficient frontier of a portfolio and you're combining stocks, bonds, and commodities or commodity trend, your allocation should be anywhere from like 30 to 60%, depending on who's running the study and how you're using it. And we talked about Eric Crittenden's done amazing things where he blinds people on what the asset classes are. But once again, so if you're building up risk parity, you're going to have that larger allocation. But once again, this is maybe why people are beating up risk parity as levered bonds, because they don't want to think about adding commodities.
Of an appropriately levered strategy, though, right? So this is the big issue, is like you say it should be 20 to 30 to 40% managed futures. Well, if managed futures or CTAs, commodity trend advisors, trend following, is being run at 10% vol versus 40% vol, those are very different risk allocations that you would then need. So I think typically the studies I see are for managed futures that are sort of in that 12 to 15% vol, which is actually kind of hard to achieve in a 40 Act vehicle. Because again, those commodities get shoved into a Cayman blocker, which can only be 25% of the portfolio. So for that 25% of the portfolio to achieve 10% vol, that Cayman blocker needs to be run at 40 vol.
Right.
Right.
My favorite, though, did you ever look back at like the in the 70s, during stagflation? So that's where these CTAs or commodity trend followers really got famous for what they did. But those guys were running like 60 to 80 vols, and they felt you're a pusillanimous to be running like 20, 25 vol. And now most of these firms are running like 5 to 10 vol. So once again, to your point, is also try to find a manager that will run in that sleeve like a 40 vol to be able to attenuate that your portfolio in an ETF structure.
I think it's legitimately impossible in a 40 Act vehicle for both the construction that needs to be done with the commodities going into the Cayman blocker, as well as from a regulatory perspective. There's new derivative rules that are coming out that in some ways are more flexible and give better guidance to managers who are using derivatives, but in other ways very clearly define, for example, that the statistically, it's called the Var Rule that's coming out. Statistically, your portfolio should never lose more than 20% of its value over the next 20 trading days, 99% of the time. And so you have to run all these simulations to figure out and have a chief risk officer. So the problem is, if you run at 60 vol, you're going to be in violation of that all day long, right? It just is going to limit what you can intrinsically do from a leverage perspective, which maybe is appropriate for a mutual fund that's available for anyone to buy. Like, I don't know if this regulation is right or wrong, but that's not for me to decide. It's there. I just have to adhere to it.
Yeah, and speaking of like nebulous things like VAR and everything, and I think there's both good and bad there. But I always, whenever I hear VAR, all I think is 60% of the time it works all the time. Like the Panther cologne. Okay, so we got stocks, bonds, commodities. What's your next?
I want to go back to the stocks thing real quick. Okay. So Meb said the first choice was foreign stocks.
Foreign stocks, yeah.
And it got 25% of the votes.
Yeah, basically each guy got like a quarter of the vote.
So I have
correct.
two thoughts.
Well, I actually got the most. Yeah, go ahead.
You have a 60-40, and you're going to add foreign stocks as the best diversifier to that portfolio. One, that feels like it's ludicrous to me, because the beta between foreign stocks and U.S. stocks is like 1. They are so highly correlated. That seems like complete nonsense to me. But then I sort of go, maybe it depends on which foreign stocks. And we talked a couple episodes about my buddy Mike Philbrick, your friend as well at Resolve Asset Management. He and I were talking about the idea of the North American risk parity portfolio, where you take US equities, which are very tech dominant, and you pair them with Canadian equities, which are very energy heavy. And you basically have this like very interesting return profile that tends to zig and zag at different times. You get a little bit of currency diversification with the commodity currency, with the Canadian dollar. You get the tech and innovation and all the freedom of both countries. It's sort of this interesting play. That said, it doesn't come anywhere close to the diversification benefits of other things you could add. But it did get me thinking, like, in certain cases, it could be an interesting diversifier. But I still can't believe 25% of people thought it was the best diversifier to add.
To clarify, at least the one I have is it's over 29% of people. So it was the most selected category. But like
that
you said,
has to be
really
trolling, right? That can't, like, people. I don't know.
Maybe. And then, but the other one that people also clicked on is gold. And, you know, actually in the Harry Brown portfolio, it was stocks, bonds, gold, and cash. And gold was an inflation hedge for him. But we've talked about like the idea of gold as an inflation hedge works over multi-decade time horizons going back, you know, centuries. But it doesn't mean it's going to work, you know, in any intervening month or quarter. So it's not necessarily a great hedge. And that's why you bring in those commodities or CTAs, where you have a much higher beta to inflation than you potentially would have with gold. And that's another reason why in this scenario of the questions, why, you know, trend was a much better allocation given the options. The other one, the last one, though, was real estate. So is that the other addition and one of the other additions that you'd make to a risk party portfolio?
Well, let's go back.
I'm going to say party every time.
Let's go back to gold really quickly, because I think the evidence here is sort of questionable. You know, not to say this time is different, but first you have to ask what kind of inflation. Right. Next, you have to ask, has the world fundamentally changed? Gold used to back currencies. Gold used to be stored by kings and queens around the world, right? It was the ultimate store of wealth. And we have, in the last 100 years, moved past that. Now, people might say it's still going to retain its value as a store of wealth, but I question whether, unless the government really needs it as a store of wealth, is the demand for gold ultimately there. One of the things we've seen, and there was an academic paper that came out a year or two ago about this, is that the financialization of gold, making it easier to buy and sell with funds like ETFs, has actually changed how sensitive gold is to real interest rates. That gold simply seems to be more connected to supply and demand than it does to actually changes in real interest rates, which might suggest it's not really tied to inflation risk much anymore. It's tied to the whims of people's views about inflation, which maybe is a bit tautological, because that's how maybe all markets work from a Keynesian perspective. But gold's a tough one. Who are you blowing kisses at?
My 2-year-old niece is leaving. She's blowing kisses. She's not going to leave until I blow a kiss back.
No, well, that's fair.
You know what I got? You know what I taught her? Sorry, I just totally derailed you. But you know what I taught her the other day? She was at Whole Foods, and these people were talking to her, some random people in Whole Foods, and they asked her, "How old are you? You speak so well." And she goes, "I'm 2 years old, and Uncle Jason's number one."
Wait, so we need to tell the people. I need to go into Happy Town here for a second. We need to tell the people. You were in Miami for the F1 weekend.
Yeah.
You are doing this. I know a number of people who are there, by the way. You are doing it better than anyone I know could have even imagined doing it. Tell the people.
No, I'm not. Come on, man. Why are you trying to blow up my spot?
Because it's so cool.
A good friend of mine, shout out to Nick Rodden Jones. He happens to be very familiar, that's all I'll say, with the Team Red Bull. So I'm a guest at Team Red Bull for F1 weekend. So I'm very excited about it. It's my first F1 race going to.
You couldn't get a +1.
I did invite you, but you're. I'm never leaving Cayman.
Well, you didn't tell me what the opportunity was.
Yeah, well, that's it.
I
always give you a mystery box. I've given you like 4 mystery boxes in the last few months, and you won't take any of them.
If I had known that I wasn't going to be sleeping on a couch somewhere, but this was like princely service. I definitely would have shown up.
So taking it back to risk parity again. So we discussed gold, commodities. So the ideal would be real estate, but also it reminded me of, real estate, depending on what are you going to use, REITs, and then you're going to have a high correlation to stocks, obviously. But then if you're going to use private real estate, it's not so easy. You don't have the granularity of the portfolio. But then if we're also using target vol for our risk parity, it reminds me of I think you tweeted out today or yesterday. It's like in 2021, PE had a volatility of 0 according to
Right.
PE
Yeah,
firms or something like that. What was your tweet?
I said, I don't understand why everyone's so against illiquid assets. My VC portfolio is down 0% this year. Asterisk, March to Q3 2021 numbers.
Yeah.
Wait, which is tongue in cheek, but I don't know. Real estate to me, I don't get either. People say it's an inflation hedge. Maybe. I think a lot of the evidence suggests it's hugely tied to GDP growth, and you already get that with equities, right? Like a lot of the thing about equities, what I love about equities is that you get so much exposure to a lot of different things by buying a company, especially like a national company. You get a hugely globally diversified revenue base, and a lot of corporations own commercial real estate. So you're getting real estate exposure through equities as well. Like there are hard assets that are owned by companies. There's actually an argument people make that you shouldn't just buy commodities, you should buy commodity producers because you get the commodities as well as the growth engine behind the commodities. I'm not sure I adhere to that philosophy, but again, I think it's worth acknowledging that equities give you a tremendous amount of diversification when you buy a large, broad basket of them, particularly if they're multinationals.
Yeah, like talking about commodity producers, you're making a parlay bet, right? You got to get the commodity direction right and then the producer direction right as a business. And then, like you said, there's, people always like to say, real estate, depending on if it's like, I guess, rental real estate, you would say is inflation hedge if you can eventually keep up, rents with inflation. But you're also, like you said, it's been highly correlated with deflation. Is basically as interest rates have come down, you've had cap rate compression as well. So that's where people are really making the money in real estate. And so it'd be interesting to see as it shifts into the future. Is a lot of people are worried about rising interest rates and how commercial real estate developers or investors are going to handle that. I don't think that's as difficult to handle as hedge or as like financial repression. What if you start having rent controls, et cetera, and now you're just in a losing position in perpetuity? So
Right.
people have just ridden this wave of amazing, 40-year growth in real estate and commercial real estate. So it's
Well, I know
interesting
here in Cayman, there is no rent control, and my friends are starting to get quoted rent prices that are 10% plus increases year over year from rent they were already paying. So you're starting to see. I mean, I know from at least just looking at my grocery bill, my grocery bill is up 30% year over year. And if I was staying in this unit, my rent, I'm leaving this unit. I'm actually coming back to the US, but the rent they're asking now is 25% higher than the rent I pay.
But like you said, but it's still also lagging though, right? You're usually only re-upping that once a year. So that's part of the problem too, is like it's a lagging indicator.
But it goes two ways though, because if when like COVID hit, rent plummeted, right? So but again, I think it's not always inflation. It's tied more to economic growth, at least around here. I don't know. I don't see real estate. I know everyone calls it a real asset, but I don't see real estate typically being anything but a correlated GDP play, not necessarily an inflation play.
Yeah. And then so, we started talking about other asset classes, but I do want to touch on one thing that we haven't really discussed. We were talking about variance or volatility. We're talking about correlation, and we were talking about what can happen if you have a target vol and like a liquidity cascade or a VAR event. But one thing I want to point out is, and we talked about Dali at the beginning having 16 uncorrelated return streams, which I believe is impossible because at the end of the day, there's really 3 correlations, right? There's correlated, which, correlations of 1 with the equity markets, which we see almost everything correlations go to 1 in a sell-off. Or you have uncorrelated, which means can be positive or negatively correlated at any given time. And this is typically where we see the CTAs or trend followers. Just based on the strategy alone, they typically tend to be uncorrelated over time frames to your equity or your long GDP portfolio. But then you can have the structural negative correlation with like buying puts on whatever asset class you want. So that's what maybe people are missing to me. Like, you and I talk about this often, is like maybe the future or the current state of play for risk parity is using a risk parity portfolio with as many asset classes as possible, and then maybe overlaying some puts in there to make sure you don't get smoked in a VAR event.
Jason, this sounds like it's quickly creeping into an advertisement for this portfolio. Oh, it must be Chris Cole's Dragon portfolio you're talking about here.
There you go.
Let's, without pumping you up too much, Jason has done a ton of work on this.
Let's not talk about me. Let's talk about Chris Cole's
all right,
Dragon.
We're going to talk about Chris Cole then. Just know that Jason has done a tremendous amount of work on this. You should Google him on these topics. Chris Cole wrote a paper about something called the Dragon portfolio, about if you were trying to buy a portfolio that you were going to buy and hold basically for 100 years, what would you own? And one might argue that is a question about all-weather investing. But the way Dalio did it at Bridgewater, it was all about buying assets. Chris sort of expanded it to say, what happens if I buy strategies? And what he found, correct me if I'm wrong, it's the blend he found was approximately 1/5 global equities, 1/5 treasuries, 1/5 gold, 1/5 CTA, and 1/5 long volatility. Now,
correct.
Defining what it means to be 1/5 long volatility, it's like, well, that doesn't mean you're spending 1/5 of your money buying put options every month because you'll go broke very quickly.
Yeah.
Like that's sort of a nebulous concept of allocating capital to a strategy like that. But the point being, it ended up, and he ran an optimization, it ended up being incredibly close to just equal weight across these things. And it was interesting to see that you had the inclusion of strategies in there as a ballast versus just trying to manage the economic regime risk through different asset classes. By the way, Jack, if you'd like to come in and join us and tell us all the ways in which I'm wrong, as you want to do.
What's going on in the comment section is I would love to look at the comment section, but I get way too distracted, and it's better for me to listen to Corey's melodious voice.
Yeah, Corey. So what you're saying is that
don't trigger me, Jack.
Risk parity is levered stocks and levered bonds, right?
No, it's levered stocks and unlevered bonds. That's the future of risk.
Yeah, we're flipping it. Yes. What I am saying is risk parity as a concept means just holding your assets in equal risk contribution. In practice, people do that with much more than just stocks and bonds. Any risk parity in the world that you find will most likely hold stocks, bonds, commodities at the very least.
All right. So are you saying that there aren't any like 60% stock, 140% bond portfolios, or is the amount of those types of funds vastly overestimated by people like me who correctly think that risk parity is stocks and bonds?
Who incorrectly think. A nice slip. I have never found one. I've never met a risk parity manager who manages money that way. That is not to say there aren't levered stock bond funds. So Wisdom Tree, for example, runs a levered 60-40 portfolio. It's not a risk parity portfolio. It's just levered stocks and bonds. And if you buy it, you know what you're buying. You know it's a levered stock bond portfolio, and you're using it for the capital efficiency that it can bring to your portfolio. But there's no institutional money managers out there running around going, I'm running risk parity, and it's 80% TLT, 20% SPY. Like, that's just not happening.
Okay. How much money is in the levered 60-40 portfolio versus how much is in the risk parity bucket?
Well, levered 60-40, I don't know. There's maybe, that ETF has $1 billion, and risk parity as a category probably has $350 billion. And that's not even ETF. Levered up.
Yeah.
So you lever, I don't know how much is in the risk parity ETFs because they're not that popular. But like institutional risk parity mandates that are used by pensions and endowments, you've probably got $350 billion allocated that is then being levered up 3 times. So there's probably close to $1 trillion in notional exposure to risk parity strategies.
And Corey just said something that's so true, is you actually only hear about risk parity or permanent portfolio like after a market correction or when there's fear across markets, because usually people don't give a shit about either of those strategies or proper portfolio diversification until they're scared, and that's when you start hearing about these things again. Which one of you has the car alarm in the background, or is that?
By the way, I love that. Yeah. This might be my favorite comment. Corey's voice is like a bagpipe in super slow mo. Wow.
This is why I can't look at the comments. I get way too distracted.
So Jack, I think from to your point, right? Let's say there were a ton of levered stock bond portfolios. Seeing increase in correlation might cause them all to have to delever at the same time. Could that be a systemic risk? Absolutely. And you are seeing that happen within risk parity portfolios themselves, right? That someone running a stock bond commodity strategy is decreasing their exposure to bonds, is decreasing their exposure to stocks, but less than you might think they have to, because the commodities are balancing them. So when they look at the aggregate volatility happening at their portfolio level, all the losses you're seeing in stocks and bonds are being somewhat offset by the gains in commodities, and the portfolio volatility is being mitigated somewhat.
There's also another way of looking at the trend following CTAs too, is like you're essentially getting levered long those asset like stocks and potentially stocks and bonds on the financial side of the commodity trend advisors during bull markets in either asset class. And then when it shifts, you're actually getting a hedge on the other side of your buy and hold or long position. And Corey, do you feel that's accurate, or is that an erroneous way of looking at it?
You know how you said you can't look at the comments because then you stop listening? That's 100% what just happened to me. So I'm going to pass that question to Jack. Jack, you answer for me. Get it right.
I also was looking at the comments.
So Jason, you were talking to the audience. Hopefully the audience has a good answer for you.
Yeah, no, it was just the idea that commodity trend advisors added to stocks and bonds can give you double the leverage during bull cycles if the trend is continuing on the upward side, and then gives you a hedge assuming the trend is the downward side. So it's another interesting way of overlaying leverage typically in that portfolio.
From a purely theoretical perspective, I think sort of like the optimal mix when you think about it would be you hold a risk parity portfolio and then you add managed futures on top, because the managed futures internally, the asset allocation is going to look a lot like the asset allocation you see in risk parity. The problem when you think about having a 60-40 plus managed futures is that you don't get the hedge to the equity side, because managed futures, they see a negative trend in equity and they start shorting equities. That it's true they will, but because of that volatility scaling that happens, and again, because equities tend to have the highest volatility during down markets, those positions get compressed almost to zero. So when you look at 2008 and you say, wow, CTAs did really, really well, it wasn't because they were shorting equities. In fact, I think CTAs generally historically have not made a lot of money from trend following equities. It was from actually trend following bonds that they did.
Yeah, it wasn't telling Q4 in 2008 too, where that
so it was a big sort of basis trade there, that there happened to be a trend in something else that helped offset the losses in equities. It wasn't the fact that they got the short equity exposure. If you were to put managed futures on top of a risk parity, at least the position sizes would more closely echo each other in theory.
Right. And then the other piece to that I think, hopefully people get is like, there's so much nuance to here that we can't even cover. And like you just started referencing a few of it, is like trying to find a CTA trend following strategy that is still running a decent size vol to help offset the other asset classes, but more importantly, that is still running at least 40 to 50% commodities, because that's been what's happened is in the last decade plus, when people are trying to raise more assets under management, they've reduced their volatility because that's what the clients wanted, and then they also, as they grow, as their asset gather and start getting 1 billion, 2 billion, 10 billion assets under management, they're capacity constrained at the individual commodity level, so they go back over to the financial side and they primarily trade the stocks, bonds, and FX. Or even rates. And so that is what you also have to be careful of, is what comparison are you using. You have to look under the hood, just like with everything else. You should want to know what you're investing in. Legibility.
Well, this is an interesting point. A friend of mine, Andrew Beer, who runs DBMF, the ETF, would actually argue you don't need that much exposure to different commodities markets. That if you probably only need, and that's if you're trying to replicate, say, the SocGen CTA index. To replicate the SocGen CTA index, you really, in his view, only need like 10 different contracts, and it's just like a couple of equity, a couple of bond, and a handful of commodities. And for the most part, they correlate well enough with each other that it doesn't matter. You don't have all the ags and all the softs and all the precious metals. It's like when the precious metals are moving, buy gold or silver. It doesn't really matter. And at least in my opinion, his track record does a pretty good job of having high correlation to the SocGen CTA index, but doesn't mean you're not giving up some potential alpha, right? There might be some alpha in those small markets that a large player can access because the large players are priced out.
Yeah, you could use one contract maybe from each of the subsectors of, come out like, one representation of metals, one of softs, one of, that's possible. And quite frankly too, is like, as is CTAs may be tracking over 80 markets, but they may only have 5 to 8 positions on anyway. So that's what I was originally thinking when you're saying that too, is like you still need the trend to manifest itself. So you're not, even though you're looking at 80 markets, you're not going to probably have 80 positions on. That's not how it works.
I would like to address LCOWX in the comments, Jason, who is telling us that we could not be more arrogant fucks, or FKS. I assume that means fucks. I just want to point out, I am incredibly arrogant. Jason's actually very humble. It's just unfortunate he has to be on with me.
I was trying to think of what else FKS could stand for.
I'm pretty sure it's fucks. I think it's a little weird that you would insult me and not just completely spell out fucks. I'm actually more insulted by that, but alas.
Well, I think that might be a perfect place to end it. Corey, maybe next time we can get to return stacking and talk about how that would be, what the similarities are with Risk Parity and whatnot. And by the way, if you can't figure it out, I'm really going for MEB's Risk Parity, and I'm trying to keep that train rolling. I mean, come on, it's so much better in Risk Parity. And as we know, a lot of these things have just terrible naming conventions. So let's make this stuff a little bit more fun.
I like the Risk Party.
Yeah.
Wait, I got a question for Corey.
Yep.
So Corey, so you've disproven the claim that trend following is just stocks, levered bonds with your
Risk Parity.
Risk Parity. Yeah, Risk Parity with your arrogant facts and your condescending true statements and knowledge. But I think a key claim of people who say Risk Parity is just stocks, levered bonds, which up until very recently I was one of those people. A key claim underlying it is that the flip in correlation between stocks and bonds, it used to be a negative correlation. Bonds for 20 years have been a hedge. Now no longer. They've been extremely correlated to stocks. That has sent a shockwave through financial markets over the past 5 months. Is that true or no?
I don't think it's true.
No. For buy and hold 60-40, true. But like he's saying, you're going to reduce your exposure to those positions.
Yeah. So for
You're
the right
adjusting in real
again,
time.
let's say Risk Parity was just levered stocks and bonds. What would happen is as the correlation goes up, the volatility of that portfolio goes up, and you would just start adding cash. And so, yeah, that could send a shock wave, but that correlation has been going up for more than 6 months now. And so it's a slow degrossing. On the other hand, you're not seeing a degrossing happening in strategic asset allocation, right? Your traditional 60-40 or your glide path type portfolios that are in target date strategies. And you're not going to. But a lot of that is what I would call stubborn long money. It's just people who are contributing part of their paycheck every 2 weeks, and that's not going to disappear because volatility went up because they've got a 50-year horizon or a 30-year horizon or whatever it is. So I'm not sure the people who are saying, I mean, Harley Bassman, Convexity may have been over at Simplify, keeps pounding the table saying Risk Parity is blowing up, and I keep sending him charts saying, show me where Risk Parity is blown up, Harley. And he just ignores me. I'm not seeing it. I don't think the data supports all these claims that this is causing people to blow up.
Right. Okay. But isn't the sort of the high octane quantitative risk parity world that you are in, isn't that much smaller than in terms of dollars than the people who just are in with Vanguard and State Street, the stubborn money? Like there's been a lot of losses in the financial system. That's what I'm saying.
Yeah. So target date funds are probably $3.5 trillion. As I mentioned before, risk parity institutional mandates are probably about $350 billion. So you're talking an order of magnitude difference there. So has it? But when you say it's sent shockwaves, are people reeling from losses? Oh yeah, your 60-40 portfolio, which is, if you ask any financial advisor, they probably have 80% of their money in a 60-40 portfolio, like dollar
minimum.
Weighted, that is
where
almost all the money in the world is. What's it down? 12% year to date?
Down 12%?
Yeah, 60-40 portfolio. I mean,
down 13,
down 13. So are people reeling from being down 13? I don't think so. That's just not, we're not at the, I mean, again, 2008, a 60-40 was down 35, 36. So, I don't think we're at the point where people are reeling yet.
I guess because so much of the bond percentage is like short duration investment grade bonds, and the spreads have not really widened that much on those. And also, if rates go from, if the 2-year goes from 50 to 250 basis points, you're only down like 3 or 4%. So it's not. But I guess
and you'll be reinvesting because those are rolling indices. You'll be rolling into the higher coupon soon. So yeah, I mean, it's not to say like this isn't the first time in a long time that you're seeing stocks and bonds in pain together for a prolonged period. That's definitely new. But I don't think we're seeing the types of losses in these portfolios yet that you're getting panic across the street and people start de-risking like they did in 2008.
And like you said, 2008 was down just over 30% for a 60-40 portfolio. Corey, have you ever looked at, I think in 1930s, the best guess, like, trying to figure the data out, I think it was like down 62% for 60-40. Can you imagine if we saw a scenario like that again for all these target date funds?
That's pretty wild.
That would be pretty wild. All right. Cool, guys. Thanks for coming on. Don't forget to subscribe to Blockport's YouTube channel. We will be here next week. Friday.
We might even do this live. Jason's going to be in Cayman.
Oh, really?
Well, I know we're doing it live anyway, but I mean, like in person.
But I mean, are we going to sit next? Are we going to sit next to each other, shoulder to shoulder, like we're conjoined twins? And like, how are we going to pull this off?
Let's figure out the details later. But let's get the crowd excited.
Yeah. Well, it's a good thing that Corey, we got to share your knowledge, and now we know that Risk Parity is selling deep out of the money puts on SPY, and also hedging them by selling out of the money puts on TLT.
Jack, you're a beacon of truth.
Yeah, it's true. All right.
Thank you, everyone. Let me do an outro. Ready? Thank you, everyone.
Return stacking next time.
Return stacking
next week. I'm Corey Hoffstein. You can find me on Twitter at @CHoffstein. That's Jason Buck. You can find him on Twitter at JasonMutiny. That's backwards again. That's Jack Farley over there, who's been managing behind the scenes. You can find him on Twitter at JackFarley96.
You got me. Wow, yeah.
We're on Blockworks. Don't forget to like, subscribe. You can leave some comments in the comments section. I promise you, I will read them. I probably won't reply. But
because you're arrogant fuck.
Yeah, well, the more atrocious the comments are, the more likely I am to bring them up. So
he's not an arrogant fuck. He's an arrogant FK, whatever that is.
Yeah, that's right.
And next week we will be talking about return stacking. Thank you so much. Have a good weekend.